So this last week of the quad, we're going to focus on one topic, and that's capital budgeting decisions. You'll remember a few weeks ago, we studied the preparation of an operating budget, a budget for our day-to-day operations. Capital budgeting is a little different because capital budgeting typically involves a large initial cash outlay, or at least a large initial investment that we are going to look for a particular return in the future. And oftentimes it also entails looking at how we're going to finance that investment. There are a couple of ways that can be used, approaches that can be used to look at capital budgeting, and we're going to go through a few of those. They typically involve a couple of concepts. One is, in some instances, the time value of money. You may remember, I hope you remember from financial accounting, in the chapter on bonds, we talked about time value of money and the fact that a dollar today is not worth the same as a dollar in the future. And you went through the process of pricing bonds based on the required return by the market. And you may remember that you used some tables that were in your textbook. We have those same tables in our textbook. They're in Appendix 13B of your textbook. And if you want a little bit of review on time value of money, other than what we're going to walk through here, Appendix 13A in your textbook walks you through that. But point being, time value of money enters into some of the approaches to capital budgeting, but not all of them. The other thing that plays into it is cash flow. So in the operating budget, we looked at budgeting what our profit would be, and oftentimes that entailed incorporating non-cash expenses such as depreciation. For most of the approaches to capital budgeting, the emphasis is on cash flow versus net operating income. There's one exception to that, but typically what we're looking at is how do we recoup our cash investment? Conversely, what return do we want to see on our cash investment? So of the four methods that we're going to look at, all but one of them hone in strictly on cash versus net operating income. So with that background, let's look at this example. What we're going to do is we're assuming, if I can get up here, we're assuming that we're looking at investing in a machine that will cost us $225,000. This machine is anticipated to reduce our operating costs by $48,000 per year. So notice, in this particular example, we're not necessarily looking at a production of revenue, generating of revenue, but a reduction of costs. Either way, whether you're generating revenue or whether you're reducing costs, you're getting a return on your investment. For our initial example, we're going to assume that this machine has zero salvage value. So in other words, when we're through with it, we will not be able to recoup any of that $225,000 cost. We're going to assume a useful life of 8 years, and then we look for a rate of return on our investment of 8%. This is typically what you're going to want to incorporate into your analysis for a capital budget decision. What rate of return do we require? And most corporations, most companies, organizations have a policy that they look for a particular minimum rate of return on their investments. So in our example, that's 8%. Okay, so let's look at a few ways that we can evaluate this investment. And that's what we're looking at. Is this investment something that we want to embark upon? Does it meet our requirements? So one approach, a very simple approach, is what's called a payback period. Now this method does ignore the time value of money. Basically what this method does is it looks at how long is it going to take me to get my investment back. Now, I want to add another comment. In all of these examples, for simplicity's sake, we are ignoring tax. Keep in mind that a tax implication will alter our evaluation a little bit. So, how long does it take us to recoup our $225,000 investment? Well, if we're looking at an annual savings of $48,000, then all we really need to do to calculate how long it takes us to recoup our investment, in other words, our payback period, is to take our initial investment and divide it by the annual savings of $48,000. And what that shows us is that it will take us between 4 and 5 years. So in the 5th year, we will recoup our investment. Now, notice we're totally ignoring that required rate of return. There is no time value of money being considered here. It is strictly $48,000 a year. How long will it take? So the required rate of return is not our benchmark here. If we're using the payback period, what we're going to look at is how long are we comfortable with it taking us to recoup our investment. And the other thing to keep in mind is that this is a useful tool also if we're examining multiple alternatives, because if we're looking at 2 or 3 alternatives that basically give us the same capability, if you will, then what we may be doing is looking at which one will we be able to recoup our investment the quickest. Okay, so payback period does not involve time value of money. A method that is, I would say, one of the more widely used methods for analyzing capital budgeting alternatives and does take into consideration the time value of money is net present value. So what net present value does is exactly what it says, if you will. It takes your cash flows in and out for this particular project and determines what the current present value of that is at the required rate of return. Now, as long as the net present value is 0 or higher, then you will effectively be achieving your required rate of return. If you get a net present value that is a negative number, then what that means is this particular project is not going to yield that required rate of return. Now, let's look at this example, and I'm going to walk through it in 2 different ways. The tables that I alluded to earlier, which you can also use Excel to calculate net present value. So I'm going to walk through that approach as well. But let's do the tables first. So our cash flows are, in essence, in this example, two sources. The initial investment of $225,000, which that is an outflow, and it is being made today, if you will. So that is already at present value. We do not need to adjust that initial investment. Then we have the annual $48,000 in savings for the 8-year life. You may remember a term from financial accounting when you learned initially about time value of money. It's called an annuity. That is a cash flow amount, periodic payment, that is the same every year. This is an annuity, this $48,000. So if I want to present value that, what I'm going to do is I am going to go to those tables in Appendix 13B, and I'm going to go to Exhibit 13B-2, which is entitled Present Value of an Annuity. And I'm going to find the factor that's just refreshing your memory on how this works, that intersects with the period of time, in this case 8, and the interest rate, in this case also 8. So if we find the 8% across the top and the 8 periods down the side, we find a factor of 5.747, which I have entered into this cell. The present value then is calculated merely by taking the annuity of $48,000 times the 5.747 factor, and that gives me $275,856. Notice the savings is a cash inflow. With a present value of an investment of $225 and the present value of the savings, annual savings of $275,856, we get a net present value of $50,856 positive, which tells us that this investment does indeed give us a minimum rate of return of 8%. It's actually higher than 8%, as indicated by the positive net present value. All right, let's walk through how we would do this using Excel. Again, the investment is the same thing. It's going to be equal to, the present value of the investment is equal to the investment. What I have done for the present value of the annuity is that I have put in a function which is PV, and then let me show, and then it incorporates into the calculation the 48,000, which is the amount of the actually the first thing is the required rate of return, which is the 8%. That's B7. B6 is the number of periods, which is 8. And then B4 is the periods, which is 48,000. And that yields 275,839. Notice there is a slight difference between the two methods. That's normal, primarily because this factor that we're using has been truncated, whereas the Excel function will, of course, carry everything out as far as it needs to go. But the differences that you should get between the two methods are negligible. So in this case, we come up with, using Excel, a present value of 50,839. Either method, as far as I'm concerned, is fine, whichever one you're more comfortable with. Now, again, we can use this net present value approach to do comparisons between alternatives, because if we have 2 or 3 alternatives and we calculate the net present value of each, all things else being equal, we would go with the alternative that yielded the highest net present value, which would indicate it's yielding the highest rate of return. Okay. Let's look then at the internal rate of return. What the internal rate of return method does is it actually calculates for us what rate of return we are getting on our investment. And so what we're going to do is we're going to take our 225,000 investment, and whereas before we took our required rate of return and present valued our cash flows based on that, here what we're going to do is actually calculate the factor that would be reflective of the actual rate of return that we're earning. So to do that, all we need to do is divide the investment by our annual cash flows, which in this case is 4.6, gives us 4.688. Now, what that tells us is that's the factor from the table that reflects our rate of return. So if we go to the table for 8 periods and go across and look for 4.688, what we immediately discover is it isn't there. What we do know is the factor for 13% is 4.799, and the factor for 14% is 4.639. So what that tells us is our rate of return falls somewhere between 13 and 14%. Now, we could just stop there. That's clearly in excess of a required rate of return of 8%, so it would meet our criteria. We can, however, extrapolate and determine the exact rate of return that we are earning. And to do that, what we're going to do is we'll take 13%, which is the 4.799 factor that came straight off the table, our IRR factor, which is 4.688, and then 14%, which is the factor for 14%, which is 4.639. Now, what we do is we take the difference between the factor at 13% and 14%, and then we take the difference between the factor of 13% and our IRR, and we can calculate, and this is incorrect, this should be 13%. We can calculate our actual rate IRR by taking the 13%, which is the lower of the two factors, and adjusting it by the difference between, notice what I've done, I've taken the difference between 13 and 14% factor, divided it by the difference between the 13% factor and the IRR factor, and then multiplied that by the 1% difference between 13 and 14. In essence, prorating that 1% difference between 13 and 14 based on the difference between the factors. And what we find is an IRR of 13.697%. Do I expect you to do that in this class? No. If you're calculating an IRR and can identify that it falls between within 2%, two interest rates, that will be fine. But I thought I would show you that. Now, the last method is what's called a simple rate of return, and this simple rate of return it's sometimes called the accounting rate of return, because what you're doing here is you are actually determining the rate of return of income on your investment, not cash flow. Now, for us, what that means is that we need to determine the amount of depreciation on this machine that we're acquiring. And we're going to be very simple. We're going to assume straight line over the 8-year period. We already know there's no salvage value. So I've calculated the depreciation here just by taking the investment of $225 by the useful life of 8 years. That gives us $28,000 annual depreciation. The initial investment, of course, is $225. The simple rate of return then is going to be the savings of $48,000 reduced by that depreciation, which effectively is going to give us our accounting net operating income generated by the investment. And then I divide that by the investment. The fallacy with this method is twofold. Number one is it does not focus on cash, which when you're looking at a cash outlay, really what you want to know is what cash am I generating from that. And secondly, it ignores the time value of money. And you can see we have a simple or accounting rate of return of 8.83%. Okay, let's look at this next page worksheet. I have incorporated another parameter, and we're only going to focus on the net present value for this. But oftentimes when you have a project that you're investing in, not only do you have the initial cost of the project, but you may actually need some working capital to get it going. And that may require an additional cash investment. But more often than not, that's working capital that you will recoup at the end of the project. So what I'm assuming here is everything is the same, but we do have a $5,000 working capital that we're going to need to invest at the beginning, but we will recoup it at the end. So let's calculate the impact that has on our net present value. We still have our $225,000 investment, but it's now increased by the working capital investment of $5,000. Notice both of those are investments made today, so present value and raw dollars are the same. The present value of our annual savings doesn't change. It's still $48,000 using the factor for 8 periods and 8%, giving us $275,856. But then at the end of the 8-year period, we're going to recover that $5,000, but we need to present value it. Now, the distinction between the $5,000 and the $48,000 is that the $48,000 is a periodic payment every year, annuity. The $5,000 we're only going to get once at the end. So if you want to pull the factor for that, you're going to go to table 13B-1, which is the present value of 1. The process is still the same. You're still going to find the 8% intersection with the 8 periods, but it's a different table, and you'll notice it yields a much smaller factor because this is a one-time payment, not a periodic payment. And that leaves us with $2,700 for the present value. Our net present value under this scenario is $48,556. And then we can do the same thing using Excel. Everything is identical to the previous example. The one difference is the working capital recovery, again, is a one lump sum. You will notice if you look at the formula that I have an empty space. That's because in this case, we don't have a payment. We have a lump sum, a single payment, not a periodic payment. And that's the way Excel knows whether or not to interpret this as one payment or multiple payments. And again, we get a little different number, but not hugely different. And then one last switch in the scenario, and that is we can also assume a salvage value. And so all I've done in this last example is taken everything we did before with the working capital, but now assumed that we're going to have a $10,000 salvage value at the end of the 8-year period. In other words, when we're through with this piece of equipment, we'll be able to sell it for $10,000. All we're doing there is we're going to calculate its present value similarly to the working capital recovery. It's a one lump sum. So you'll see the space, empty space for where a periodic payment would be, and then the salvage value in the next spot. And notice the net present value is higher in this scenario where we're actually going to recoup some of our initial investment through a salvage value.